Hi, Doug Andrew here again. It's Friday, November 8th, and it's about 10 a.m. Mountain Time. Again, I'm down in St. George, Utah, where it's a little bit warmer than my home town in Salt Lake City, but nonetheless, it's about 42 degrees right now. So I wanted to share another important message because of the result of the election now that we know sort of what the next 4 years will hold. And if you missed out, I've been talking about the apparent advantages that you ought to seize during the Trump administration for the next 4 years that probably will not come again in your lifetime, I predict. And the first is that the tax rates of 22% and 24%, that would be like for married couples, taxable income up to the 300 and taxable income is after your deductions, of course. And so a married couple filing a joint tax return in 2024 can have up to 201,000 of taxable income in a 22% federal rate. It will likely never be that low again. I thought that was going to go away, especially when the Trump tax cuts of 2017, which are these tax rates, expire automatically at the end of 2025. It's called they sunset. It's now obvious Trump will likely extend those. And so, regardless, you ought to seize the opportunity to get taxes over and done with on some of your IRAs or 401ks, whether you need the money or not, sooner than later. That's called a strategic rollout. We're teaching an educational webinar on how to seize that opportunity next Tuesday, November 12th. It's free and it starts at 11 a.m. Mountain Time. You go to retirebydesignevent.com to register for that free webinar. If you want to explore that. And then we'll teach you where you should put the after-tax money so it's tax-free from now on. And probably earn a better rate of return than you're earning on your IRAs and 401ks invested in a volatile market. Okay. There's some other advantages, though, that I want to describe right now that you may not be aware of. Now, if you listen close to the two presidential candidates, and again, this is not a political video, but now, I want you to understand the facts. Kamala Harris wanted to raise taxes, which is typical. I mean, the Democrat philosophy is to raise tax revenue. The easiest way and the best way is to raise taxes, whereas the Republican philosophy is, no, you raise the revenue. You stimulate the economy. You raise the revenue out there that's being generated, that's being taxed. And that has proven many times to bring in more tax revenue than just raising taxes. And that sometimes causes the economy to stagnate and we go into recessions or what have you, okay? So this is why the stock market has responded so favorably here just in the last couple of days since the results of the election have been known. Well, what else do we know? Kamala Harris was trying to introduce a very strange, unpopular way to raise tax revenue, and that was to tax unrealized capital gains. I don't know how she was going to pull that off, but if you don't know what I'm talking about, that means that she wanted to tax every single year people for what the value of maybe their stocks or mutual funds or maybe even their real estate or maybe even their house on the increase in value based upon appraisals, and tax people on unrealized capital gains because, of course, heretofore, you only have to pay tax, capital gain tax, on those assets when you actually realize a profit or the gain by selling it, okay? And so oftentimes, the capital gain tax has been deemed sort of an unfair tax for years because you're really being taxed largely on inflation. Most asset appreciation happens in large because of the cost of living, inflation. And so it's sort of unfair to be taxed for what inflation did because, that's like this hidden tax. And so that's why the Republican philosophy has been, well, no, if you're going to pay a capital gain tax, let's tax it maybe half or less the rate of normal income tax. That's why under Trump, the capital gain taxes have been, the maximum is 20%. sometimes 15%, rather than, the income tax. Because whenever you have a capital gain, if that adds to your income that year, that will usually force you to the highest tax rate. It has for me many times. 39.6% is what you would be paying if the Trump tax cuts expired. And so, in other words, capital gain taxes were going to more or less double from 20% up to nearly 40%. So now we have a window of opportunity where you can actually get capital gain taxes over and done with sooner than later. Now, a lot of people say, well, why would I sell my real estate? Well, I found as a retirement planning specialist that many retirees, when they approach retirement, are sick and tired of being a landlord, taking out the trash, fixing toilets, evicting tenants, and what have you. And so they want out, but they feel trapped because they've been doing 1031 exchanges, postponing and deferring, so that they could pass that highly appreciated asset down to their children, and then the children get a step up in basis, which means the children would only have to pay a capital gain tax on what they sell those properties for, those assets for, over and above what it was worth when they inherited it. And so that was the advantage. It's called a step up in basis. And if you've listened, the Biden-Harris administration has even thought about maybe doing away with the step up in basis on long-term capital gains. But at a minimum, they wanted to move it back to ordinary income tax rates, which would double for many people selling assets. But then Kamala Harris introduced the idea of having people pay tax every single year on capital gains, what your investments or assets appreciated at, whether you realized it or not, which I thought, man, that's going to cause problems, because that means you have to go borrow or you have to sell it to come up with the money to pay the tax, because you're paying tax on a gain that you haven't realized yet. So where's the money coming from? It has to come from other income. And so I was really concerned about that. But let me just say this. When I teach educational seminars and webinars, there's a lot of people that have highly appreciated real estate, okay, rental properties, for example. And when it comes down to it, they really don't want to manage those anymore, but then they're faced with having to hire management so they can enjoy retirement. And then I've heard horror stories about how many of these property managers embezzle money and what have you, and the rate of return goes way down. So let me just say this. If your return or payout on your real estate is less than 10% of the value of the property, if it's worth $1 million, it ought to be generating $100,000 a year for you net after tax, okay? If it's not doing that, listen close. I would recommend you sell. Sell, bite the bullet, pay the lowest capital gain tax rate you will probably ever see again in the next few years here, and take the net and put it into my favorite vehicle that is liquid, safe, earns a predictable rate of return, and is tax-free. And it's a max-funded IUL. I call it laser fund. Laser is an acronym that stands for liquid assets safely earning returns. And every $1 million you put into a laser fund can generate a 10% payout without depleting principal if you structure it correctly, fund it properly, you diversify like we teach, and you rebalance every single year. And if you don't know what I'm talking about, don't say, well, I don't understand this. You need to, because you're missing out. Because you could reposition $1 million and generate $100,000 a year of tax-free income. And most of these real estate investors that I talk to, when they do that, they go, oh my heavens, I can't believe it. I don't have to be a landlord anymore. I don't have to worry about managing these properties. Where have you been? And I said, I've been here all along. But see, you had your blinders on and thinking that real estate was the cat's meow. And so this is an opportunity that you want to seize, especially for the next year or two, to get money out of those IRAs or 401ks sooner than later, get the taxes over and done with at today's lower rates, 22%. Married couples making under $383,000 of taxable income, you're in a 24% bracket. That was going to go up to 28%. That's 4% higher tax, but that's actually 16% more money you have to pay out in tax, because on every $1,000, if you were paying, at 22%, $220, and now you have to pay $240, okay? or now it goes up from 24 to 28. That's another $40. $40 divided into the old 240 is actually a 16% increase in money. And a lot of people don't understand this. That's why a 21% corporate rate, and they say, oh, we'll just raise it to 28. That's only 7% more. No, it isn't. It's more than 33% more. Because if corporations have to, pay now $70 more on every thousand, they used to pay $210 on every thousand of profit at 21%. Now they pay $280. That's $70 more. $70 is 1/3 of the 21%. Does that make sense? And corporations can't just afford it, and that's why they haven't expanded. They lay off, and now they're going to expand. Now they're going to hire, and watch what happens, because Trump will keep it at 21% or maybe even lower it. There's opportunities here you don't want to miss out on, is what I'm saying. And so it doesn't matter what political affiliation you are. If you own highly appreciated real estate, it may behoove you to sell, pay the capital gain tax at the lowest rate you'll probably ever see again, and take the net and put it into a property structured max funded IUL portfolio. And you can, if you want income, you can get 8 to 10% payouts tax free, or you can let it grow at those same rates of return tax free, but it's tax free. And if you don't understand why, please come and learn. Okay? So there's a lot of opportunities, and if you want to see what the results of the election mean for you, please join us next Tuesday, November 12th. I'm going to be teaching along with my son, who's one of the nation's top tax strategists, for 90 minutes. It's free. And so Tuesday, November 12th, we're going to start at 11:30 a.m. Mountain Time and go 90 minutes. And you will learn some opportunities that you probably never knew existed before, and you need to seize them sooner than later. I would love to save you tens of thousands, if not several $100,000 of unnecessary tax, like we've done for thousands of Americans. We saved some school teachers $250,000 of unnecessary tax with these strategies. We saved a real estate landlord $750,000. We saved a husband and wife couple, both physicians, $1.2 million of unnecessary tax. And they were able to take that $1.2 million of otherwise payable tax and create what I call a family bank, and that's generating over $100,000 a year of tax-free cash flow for their children and their grandchildren, for vacations, education, college, all kinds of things that would otherwise have gone down the drain in unnecessary tax. So when you can redirect otherwise payable tax to causes you support, you'll take ownership, and I think you'll manage your money better, be a better steward than Uncle Sam, frankly. Okay, so join us. Go to Retire by Design event.com. retirebydesignevent.com. Register now, and we'll see you next Tuesday, the 12th, 11:30 a.m. Mountain Time. It's free. There's no cost or obligation, and see opportunities that you don't want to miss out on. Okay, so take care. Here's to your brighter future. Have a wonderful day. Hopefully today we'll find out if the Nevada election results are in, and it looks like that's going toward Trump. So Trump will secure at least 301 electoral votes, and if Arizona, which is looking like it's going to go to Trump, finally gets their votes in the next few days, he may end up with 312 electoral votes. So, but he's already secured the minimum, of course, that he needed. So we know something we didn't know just a few days ago. So seize that opportunity, and we'll see you next Tuesday. Thank you.